lunch hour to talk about now that we've gotten the money, right, Perry and Fred? We've got dollars. Now we got some important stuff to do with regards to forgiveness and reporting and some compliance. And we definitely want to answer your questions and share some insight with regards to all of that. So Fred, let's go ahead and get to our next slide. Quick intros, go for it, Perry. Perry, can you hear me?
More technical difficulties.
All right, go ahead, Fred. You start, and then Perry will join in here in a second.
Dean is the moderator, chief relationship builder at Armanino, a partner in California. We turn to him for about everything. Perry is the managing partner in the Dallas office and the partner in charge in Texas. Has been with the firm since Travis Wolf merged with Armanino. And I'm Fred Basti. I merged my firm with Armanino about 1.5 years ago. Knew many of the partners at Travis Wolf, and it's been it's a challenge going from 15 to 1,500, but it's all been good, and it's a great firm. I'm proud to be a member of it.
Thanks for being here, Fred.
All right.
So why don't I start off, and I just want to welcome everybody and thank everybody for being here and participating. We wanted to have a smaller group to make this experience and our time together a little bit more effective, very much interaction, a lot of interaction. We're here to continuously field questions and answer your questions. And I wanted to start off by giving a little bit of perspective about the PPP program. And everybody's heard the word unprecedented in the last several months, more often than it's ever been used before, but this is an unprecedented program for an unprecedented time that we're experiencing right now. And I've been in practice for decades. I'm not going to mention how many, but decades, and I've seen things come and go, like investment tax credits and other types of credits and full deduction for fixed assets acquisitions known as bonus depreciation, all those things designed to induce businesses to invest and to expand and to make the economy more successful. But again, nothing like the Paycheck Protection Program. So we're here today to talk about really what we call the back end, and that is when these, pursuant to the law put in place, these things, these loans have the opportunity to be forgiven. And as we have familiarized ourselves and learned about it, we have come to the conclusion that, as we've learned in the past, this is not going to be an easy process. And when you deal with the government, nothing is ever as easy as they might make it sound. And from our experience, for many of us, this is like filing a tax return. I mean, we're submitting a document to a governmental agency. We're effectively asking for money from them, a refund, if you will, by virtue of this forgiveness. And it's predicated on a law that has a tremendous amount of complexity and limitation computations and catches and items subject to interpretation. And on top of all that, they want us to provide the documentation that goes along with our conclusions. So this is no simple task, candidly. So if we go to the next slide, we'll talk through to provide some perspective again on the total program. We see it as 3 different stages. We see that we went through the application and obtaining funding process. We're going to go through a process of utilizing the funds that we've been provided. And then we're going to have to go through this process of submitting the documentation as I was describing before. I want to back up for a second and go to comment a little bit about each of these stages. And we'll start by the applying and getting funding stage. Initially, a company has to qualify. And initially we thought that that was all about the size of the company, 500 or fewer employees, generally speaking, and the fact that they were in a valid trade or business. Those were the guideposts that we've always understood from the get-go. But as we got into it, there are certain representations that are made when you sign the loan documents and get the funding. And it's become really a lot of dialogue in really the last week or so about, well, do all companies that fit this box actually qualify? And as many of you know, there's been a series of guidance that the Treasury has been releasing. And for a while there, it seemed like on a daily basis, to help us clarify some of the unanswered questions. And recently they released a question and answer, a Q&A, that revolved around the representation of need. And it's a great debate, and we wanted to take just a moment or two and touch on it. Fred, I don't know if you have that language.
I do.
Yeah.
So
there's a sentence or two in there that we focused on, right?
yeah, there's on the second page of most applications that everyone had to initial certify, I don't know, 10 or 12 things, but the third one in particular gave me the most heartburn, concern, and I went over that one in particular with all my clients and asked them to read it 2 or 3 times before they initialed it. But this Q&A that came out on April the 24th states all borrowers should review carefully the required certification that current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Borrowers must make this certification in good faith, taking into account their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. Now, if someone could unwrap that for me and tell me exactly what that means and apply it to all of our clients, I would much appreciate it. But it's broad. It applies to most people, and a lot of people, after the stories on the news about the big companies that gave their money back, some people are having second thoughts on whether or not they actually qualify. I even have a client that went to the trouble of having a big law firm here in Dallas render a legal opinion on whether or not they qualified. Their loan was, $9.8 million, and so they wanted to make sure they got it right. So something to be taken very seriously. You have until May the 7th, if you decide that you shouldn't have taken the loan, to return it with no penalty.
Yeah, so what, we don't, obviously, we're not here to provide legal advice, but we do, as Fred indicated, like to remind people to pay attention to this. And as with a lot of government programs, they're designed to address a specific need. In this case, that was a very urgent need, and borrowers, pursued and went through the funding process. But on the back end, when we go through this forgiveness process, all the more reason we need to have your ducks in a row, all your documentation in place, and submit to make it a very orderly process. So a couple of other comments, as I said, the stages that we identified, the application and funding piece, the use of the funds. We think it's critically important that when you get the funds, to isolate them into a separate bank account. A couple of reasons for that. First and foremost, it's highly likely that upon review, they're going to want to see, where did the money go? And we want to be able to demonstrate money coming out of this isolated account, supported and documented by computations to demonstrate the eligible use of those funds pursuant to the law and all the guidance out there. And if they are going to track this through a bank account, we want them to track it through a bank account that's isolated for this purpose, not a bank account that includes all your other normal business activities. There's no reason to provide that to a review group. And then, of course, as I mentioned earlier, submitting documentation or a report or a filing with a government agency is something that we have experience in dealing with another agency, the Internal Revenue Service. Your best course of action is to present a complete and a well-ordered and easy to follow set of documents so they can get through it, come to the right conclusion as soon as they can. And that's an important part, again, based upon our experience dealing with the Internal Revenue Service. So the next thing we want to cover is the 3 steps that we see as critically important during the post-funding period. So now you have your money. The first thing that we believe you need to do is have your strategy in your mind clear, meaning what are you going to be using the funds for that are eligible for forgiveness, and project out actually what you think your forgiveness amount will be at the end of the road. That way you have kind of gone through the analysis, set your expectations. You can make good decisions that first and foremost meet your business needs, and then secondarily understand how much, if any, of the funding will not be forgiven at the end of the road.
Yeah, so I mean, to me, I'm telling my clients to lay out a calendar for this 8 weeks and put in their payroll when it's going to fall, so that they know they have how many ever 4 payrolls in the next 8 weeks. They see when their rent's going to be paid. Then they project where they're going to end up, and they'll be able to identify any potential problems where your loan gets funded on May the 5th. You've already paid your May rent, and your 8 weeks is up in on July the 26th or whatever the day is, and so August rent's not due yet. So you have to identify that as a problem. Then we need to figure out how to deal with it.
Correct. And this will vary for everyone depending upon their funding date, because that's the key date from which you count the 8 weeks. So after you set that strategy and you have an idea, both from a business and a forgiveness standpoint, what you're trying to accomplish, as you go through, as Fred suggests, you have this calendar, you look at your actual amounts that you're going to disperse out of this isolated account, and you accumulate your documentation at that time, whether it be your payroll cycle, when you compute the eligible payroll costs pursuant to the law, and you get that together so that it links directly to the actual funds that come out of the account. Again, you're building your file, so to speak, to put your package together at the end of the road. Then when you get to the end of the 8-week period, you should have all the component parts to organize that package in a manner that can be submitted to support the forgiveness amount that you're entitled to. And we put it in a format that whomever is going to review it can easily follow all the computations. So we thought at this stage, what would be most helpful is to go through an example. And again, any questions along the way that come up, that's what we're here for. But by way of example, we can see, how this unfolds, why you might or might not get full forgiveness, what will qualify and help you in terms of strategy to either maximize forgiveness or at least make best use of the funds for your business needs.
So you want me to pull up the...
Yeah, so Fred, why don't you pull up what we got there?
So we all noticed the big yellow qualifier. This is our template. It's based on our current understanding of how the law works. We'll get more guidance within this week, so it's subject to change. Certainly, there are many different ways to potentially interpret some of the laws, but this is just an example company. In this particular company, their average monthly payroll for 2019 was $400,000. So you multiply that by 2.5 to get their loan amount. So their loan was $1 million. Okay, so in scenario 1, they spent $800,000 in the 8-week covered period on payroll, which is really twice the $400,000 number. They had $100,000 of rent, $25,000 of utilities, and mortgage interest of $75,000. They spent all their money on this group of eligible costs. They didn't reduce their headcount. They didn't reduce. There's three ways that your forgivable amount can be reduced. Headcount, salary reductions in excess of 25% for any individual employee based on their prior quarter's earnings, or the 75% payroll requirement that came out from the SBA after the act. In this instance, none of the reductions mattered. They got their entire loan forgiven. They spent more than 75% on payroll. They spent their entire $1 million, and they didn't reduce their headcount. Scenario two.
Yeah, just saying, before we go to scenario two, that's a very simple circumstance, but it also makes it clear that you put the money in the bank, you spend it for all these eligible expenditures, you didn't have any of the events that would otherwise apply a limitation, and everything works out perfectly. Don't know how often that's going to happen, but that's the perfect scenario.
Right. So scenario two, same company, same loan. They reduced their headcount by 1. They had 10 employees. They let 1 go. So that invokes a 10% disallowance in their loan amount. They didn't have any other limitations in their forgivable amount. They only spent $800,000, so that's the most, because their salaries went down. They must have they had a payroll reduction, and they fired 1 person or let 1 person go, so their salaries went down. They didn't spend the whole $1 million, so that's the most that can be forgiven. And then they reduced their headcount by 10%, so 10% of the forgivable amount is not forgivable. So that's the maximum they can have forgiven, is the $800, what they spent, and the 1 person reduction caused another $80,000 to be not forgiven. The balance at the end of the 8 weeks would be the $280,000.
Yeah, so the way I think about that is that this company probably did some reduction in compensation across the board, it would seem. And so therefore, they didn't reduce it so severely to be penalized under the more than 25% level, but they probably did some level of reductions across the board, which was a good business decision. So this is a great example of where business decisions and forgiveness amounts will intersect. And we're always proponents of, you make your best business decision first, and then you look at the implications here and make sure that you're okay with it. But anyway, they made some reduction across the board, but then in addition to that, they had 1 headcount leave. They reduced their headcount by 1. So there's a double negative there, or double detriment. 1, because they didn't spend as much, and 2, because they actually let somebody go. Those are the 2 things that the government's focused on: keep people both employed, but also hopefully employed at the same level that they were before, if possible.
Right.
Perry and Fred, when you're speaking about business decisions, and absolutely, you have to make business decisions first and then accounting decisions second. We have a good question that came in from Sandy, and it says, if it turns out that the organization didn't need the funds, can the loan be paid back in 6 months with the 1% interest? That is, when it comes time to submit a request for forgiveness, can we just basically pay it back? And in hindsight, the organization didn't experience a potential fatal economic collapse, and just pay the money back, and kind of everything is good.
Yeah, there's no prepayment penalty. It can be paid back at any point after the 8-week funding period.
Right. But one thing I would mention on that front, going back to something we talked about earlier, this controversy about whether the representation that you made that you needed the money was appropriate. If for any reason that in this fact pattern, you felt confident and comfortable that you needed the money because of the events that you anticipated and you saw in your business activities, That's one thing. But if for some reason that you in retrospect look at it and say, maybe I really didn't need to borrow the money, there is this date, May 7th, which is coming up. And that's a date by which you can return the money, and they will never come back and ask you questions about that representation. So,
you know, along those lines, I think it probably would be good to have in everyone's file a projection of how they anticipate to spend the funds and why they asked for the loan. And if things turn out different, you don't want to be throwing that together 15 minutes before the SBA auditor knocks on the door. You want to have something in your file that shows, hey, we thought this was what was going to happen. That's why we applied for the loan. There's not a problem here. And we didn't spend all the money because things changed.
Okay. Okay. We actually have another question with regards to the forgivable amounts. What is the third way to reduce forgivable amounts? For context, one was headcount, two is salary reduction by 25% or more. What was that third one that we talked about?
The third one is, and then in scenario 3, you'll see the calculation, but there was a requirement that was added by the SBA after the act. This was not part of the original act, but they said that you have to spend 75% of your forgivable amounts on payroll. Right. So if you don't, it's anticipated, or at least we anticipate, that to the extent that you're below 75%, your forgivable amount goes down to get you back to 75%.
This is a good
That's
moment.
Not a for sure. We're waiting on guidance, but
I was just going to say
that's what we anticipate the answer to be.
Yeah, I was just going to emphasize that again. Remember that we got a tremendous amount of guidance through the loan application process. We anticipated a lot more guidance yet to come in connection with the forgiveness process. So, but right now we're working with the best information that we have.
Right. When you talk about potential folks coming in like auditors, we're thinking that those are going to be SBA folks, or are they going to be the lenders who helped you get the loan in the first place?
I think it's going to be SBA folks. I don't know for sure. And I heard yesterday Mnuchin say that anything over $2 million will be audited. I don't know if
that's what he said.
Yeah.
So, and I do think that that most people believe that it's going to be the SBA, not your lender. It's not going to be your buddy, that your bank officer that's going to be taking a quick look at your forgiveness calculation.
Yeah.
More questions? No? Dean?
Not at the moment.
Okay. Yeah, I think we're okay.
Okay. So scenario 3, same company, same loan. They cut 2 people this time. They reduced several folks in excess of 25% of their most recent quarter's pay. So they had this reduction to deal with. And then, as you can see, they didn't spend 75% of their forgivable amount on payroll costs. So they have all 3 scenarios. They've got a headcount reduction of 20%. They reduced people's salary in excess of 25%. And they didn't spend 75% of their forgivable amount on payroll. So they have actually 3 reductions. And you see how dramatic the change is on how much is actually to be repaid and to be forgiven. Again, this is our current thought on how these 3 reductions interplay with one another. Could be different. Could be a different interpretation. Could get different guidance. But I actually went through one with a client yesterday, and they had 300 employees, and we changed it to 375, and their increased salaries was less than the additional forgivable amount that they that wouldn't have to be paid back. So they actually made $200,000 by hiring back 75 more people. Kind of an odd set of circumstances, but you can see where these reductions are going to be really critical in making decisions during the 8-week period.
Right. That's why making sure that you're thinking both from a business standpoint. I'm sure that company did not decide to hire 75 people solely for the purpose of forgiveness.
No, I mean, and I'm not sure they're going to. We were just, they just said, what happens if we bring back 75 more people? They were at 1,600 prior to COVID. So, and they went down to, I think, 160, and they were planning on bringing back, they're trying to decide how many to bring back. They wanted to know the effects.
Got it.
A couple more questions came in with regards to, first one, audits. I don't think we have any insight yet on if those are going to be done electronically or physically in person. Any insight there?
My guess is it would not be with physical presence because they are going to be looking for the documentation on the front end, I think. But that's a bit of speculation. But that's it's just the fact that we have to provide a lot of that on the front end. Seems like they would have much of what they need.
Great. And then with regards to utility cost, would an IT support monthly fee, is that something that goes into utility?
I think it sounds like a managed services. So that sounds a little bit, I don't know if that's exactly what it is, but that would be more of services rendered in terms of consulting. And so if I'm correct about managed services, I would lean against that probably.
I think I agree with that. I mean, and I think by Thursday, we think we'll have some more guidance. And I would think that that's one of the questions that they will elaborate on what exactly are utilities. Hopefully they tell us how these three reductions interplay with one another. So this week we should have, we hope, a bunch of answers to the questions that remain open.
Great. What about, here's a question that I think we've seen a couple different times, but are employer taxes on employees included in payroll cost or just payroll with no tax additions and health insurance costs covered by employer?
Yeah, no federal taxes can be included. Any state tax, yes. And again, employer paid state tax.
Right.
By the way, if I answer a question, I have to wait and make sure that Fred says I'm right because Fred's the expert.
Yeah, right. Yeah, you're the
Absolutely.
IQ, right?
That's right. So I'm like taking a test. I'm like taking a test. Oh gosh.
What about, we have lots of, employee movement. So what if an employee resigns after, PPP funding? Is that a reduction? And that might be a specific question that we'll have to figure out. But any thoughts on that? Is it just
I don't know, Fred, what I've read, it sounds like it doesn't say why there was a reduction. It just says a reduction, doesn't it?
Yeah, I agree. It's average full-time equivalent employees over the 8-week covered period over one of the 2 testing periods, average full-time employee equivalents. So whether they quit on their own or were fired, I don't think it
right.
Right. So backfilling replacements is fine as well.
Right.
Correct.
Okay. And then with regards to we have a question here about utilities. Is internet service considered part of the utilities? And that is yes.
Yes, correct. That is true.
Okay. All right, gentlemen, go ahead.
Okay.
Back to the slideshow?
Back to the slideshow. So again, our strategy is to make sure we understand what our clients need and what we think they need. So I don't know if the group has really thought through the strategy, the execute, and the accumulate of the documentation, but that's what we're available to advise on, help with, do with whatever each company needs. All right, Dean, you got other questions?
Oh yeah, I think we do. Here we go. They're coming up more. Was there any kind of ruling on employer paid major medical coverage? Anything
so is that a self-insured question or is that just employer paying for health insurance, medical coverage. I mean, that's a benefit that's clearly defined in the statute.
Right.
Okay. What about payroll processing fees? A little tongue twister for you.
You know, people have been bringing that up. I've had people ask that question multiple times. I don't think that that's an eligible expense.
Great.
I don't think so either.
What are we considering the funding date? When the funds hit the bank account or when the bank secures the funds from the SBA?
The date that it's funded, I believe.
Yeah, when the borrower gets it, as far as I know. I haven't seen anything contrary to that.
Okay, great.
So most people right now have been funded with their loans. Most people on this call, I think. They're either had a payroll or they're awaiting a payroll. Right now, the most important things in my mind are isolating it in a separate account. If you didn't do that to begin with, that's not the end of the world, but I would open up a new account that has and fund it with the original loan proceeds so that every single withdrawal from that account is supported by documentation that and a computation on why and what the items were that we spent. And the second thing would be to do the projection and to also look and see and make sure that you feel comfortable that when you got this loan, you felt like you were going to spend the lion's share of it on eligible expenses. Doing the projection, I think, is going to be enlightening because you're going to see how things lay out. I've got a dog going crazy in the background. Sorry.
Work from home realities. It's all good.
That's right.
Losing my train of thought. The postman must be here or something.
I got you.
Anyway, I think that's going to make it apparent. And you won't have any surprises in week 8. If you go back to the template and think about how the headcount reduction works. Well, first of all, you're going to have less payroll in the 8 weeks period if you let one person go. Let's say you have 10 people and they all make $100,000 a year, and you reduce by one person. Well, that's one reduction. So you're going to have less payroll in the 8 week period, and then you're going to have 90%. You have a 10% reduction in that number. So in fact, your reduction is not 10%, it's 19%. I don't know if you follow that, Perry. Are you following that?
Yeah, so here's the way I think of it, and I think you're making a really good point, Fred. I think of it as if a company decides for business purposes they need to reduce their labor costs by 10%, they basically have 2 options as to how to go about it. One is they can take a 10% across the board for all employees and ask them to take a 10% pay cut, or they can reduce their headcount by 10%. And if you think about it, if you take the 10% across the board, then you're going to be penalized, so to speak, because you're spending less money. But that's okay because it's a good business decision. That's what they felt like they needed to do for business purposes. However, if you achieve that same labor cost reduction by reducing headcount by 10%, you're going to get a double negative detriment. You're going to get the 10% less that you spent, and then you're going to get a 10% reduction of that amount you spent in the forgivable computation. So again, there's a lot of business considerations there, but the mathematically, based upon the way this program works, you're better off reducing across the board, in that instance, the 10% rather than reducing the headcount 10%. Back to you, Dean.
Sure. I actually have a couple questions.
Okay.
So understand that the proceeds are not considered taxable. However, the amounts dispersed will not be deductible for tax purposes. Any guidance on this or any educated interpretation?
I think that has to be the case, but I don't think it doesn't specifically say that. It does say that the the proceeds, the loan proceeds when they're forgiven is not a taxable event. It won't affect your credit rating. But it doesn't address, are the expenses deductible, but I got to believe that they're not.
Yeah, I think the analogy to that is, and some may be familiar with this, some not, but I think of in terms of, I see, we see, let's say, trusts over the years that have tax exempt income. When the trust uses their income to pay expenses that are deductible, there's a computation that eliminates a portion of those deductions because the source of the payment was tax exempt, was not subject to tax. And I believe that's going to be, I don't know if it's section 265 or something along those lines that guide that treatment. And so we anticipate they will not, that some portion of them at least will not be deductible, probably most of it.
Great, great. Donna has a couple of questions. Since the 8-week start can be kind of random, middle of the week or other things like that, do we calculate salary based on the number of work days? Actually, calculate the salary amount for 40 days of work per se.
That's a really good question.
Good question.
And I think it's open to interpretation right now. The actual act reads payroll costs incurred and paid, not or paid, and paid. But I believe that we're going to have SBA auditors looking at this, and it's just going to be way easier for them to tie the payments out as opposed to trying to work with some sort of an accrual. Now, you can't, I think they're going to make sure that you don't have more than 8 weeks pay in the 8-week period, but I think they're going to go with the amounts paid. Also understand that a literal reading of the law is we got 2.5 months of payroll costs, and this is 8 weeks, not necessarily 2 months. And so your payroll costs are going to be a little bit less on a monthly basis under the forgivable calculation also.
Yeah, I ran across that example with a sole proprietor that, attained a loan for 20,000, whatever, at 833, which was the maximum based upon 100,000. And then when you did the computation, you would have thought that 16,666 or 2 months of 8,333 would have been the forgivable amount, but it's actually less than that. It's 15,000 something.
Right.
So
850 seconds.
Right, 850 seconds, right.
Donna has another question that I think is on the topics of many right now, and that's owner compensation. Any insight, or are we going to be getting into more of that?
Owner compensation?
Yeah.
The last thing I want to see is the owner to take out a bigger salary during the 8-week period. From an optical standpoint, it would be better if they reduce their salary, but certainly just their salary remaining the same is probably okay. Understand that the forgivable amount and the eligible cost is based on $100,000 annual salary anyway. So if they make 250, reducing to 200 doesn't really change the computations.
Right. Yeah, that's what I was thinking. If the owner compensation is over 100, reducing it won't really have an impact.
The document mentions 852 of last year's net profit, 8 over 52. Sorry.
Right. Yeah. That's, I believe, the self-employment section when they provided guidance on when you have a sole proprietor that, let's say in 2019 made, let's just keep it simple, $100,000, and maybe they were commissioned, and here they are during the 8 weeks period where there's, really unfortunately not a lot of business activity, and maybe they make zero. Well, how much are they eligible to be forgiven? And that's where they came up with 8/52 of the 2019 income, meaning 8 weeks out of a total of 52 weeks out of the year would be applied to the 2019 earnings that were eligible, 100,000 or less, to arrive at the forgivable amount.
Essentially, they're making, I think, my interpretation is they're making 8/52 of your 2019 self-employment income a grant. I mean, there's no, I can't think of a way to prove that your independent contractor income was forgivable unless you take your grocery bills and you bought pickles and peanut butter and you didn't spend it on, a yacht. I mean, I got to believe that that's what the intent is, that it's going to actually turn into a grant for independent contractors.
Sure. And what if owners are paid via, K-1s versus salary? Still eligible?
K1 income, they came out and allowed, as long as it's subject to self-employment and they're active in running the business.
Right.
Okay, and let's see here. Since bonuses are not mentioned in the payroll cost, can we provide employees a bonus using the PPP loan proceeds?
That's probably going to be addressed in guidance, and it kind of segues into a thought that I was going to mention earlier, is that because this is going to be scrutinized, I think the guidepost really is, what things do you do in the normal course of business? If somebody has a compensation arrangement where they have a base, but they have a history of receiving periodic bonuses, whether it be monthly or quarterly, my instinct, although guidance will probably come out on this, is that that might be fine, but I don't think extraordinary bonuses that are non-routine would be viewed as favorably. Fred, have you thought much about that?
Yeah, no, I agree with that. And I think that similarly, people are asking, well, I have my retirement plan contribution that's due. Can I pay it during the 8 weeks period and use that as a forgivable item? And I think the answer to that is no. It's got to be something that is actually incurred in the 8 week period. Something out of the ordinary. I mean, a modest bonus, I don't think they're going to have a problem with, but giving somebody a bonus just to put them on the government tab for the bonus, I don't think is going to be allowed.
Yeah.
Okay.
Okay. I think, Dean, we also had some questions from prior experiences that we've worked with people on. Maybe we'll touch those, may benefit for others.
Yeah, absolutely. Let's see here. Can I use the PPP funds to make 2019 profit sharing contributions?
Well, it's funny you raise that, because I've had that specific circumstance come up. And I think Fred's comment earlier was a good one, is that there really are two things that must happen during this 8 week period to be an eligible expense. It has to be an expense incurred, it has to be an expense paid. And 2019 profit sharing contribution, it was incurred back in 2019.
Right.
So unfortunately, I would suggest that that's not going to be able to contribute to the forgiveness computation.
Great. What about purchasing inventory with PPP funds?
Not a good idea. Well, it's not going to be forgivable, and it is an indication that you didn't plan on spending the money on eligible costs. And in fact, you're only supposed to spend the money from the PPP loan on eligible costs. The list.
Yeah, there's a nuance that, frankly, I hadn't really focused on, that we in the law that we identified about, I don't know, 3-4 days ago, or maybe over last weekend. There's terminology in the statute that talks about allowable expenditures, meaning things that the funds can be used for. And then there's another listing of expenditures that are eligible for forgiveness. And a lot of them are similar, but they're not identical. So one, for example, I believe that we've concluded is that interest on a mortgage for property that is used in the trade or business, that's both allowable and forgivable. However, if a company's got a line of credit that's is supported by their inventory and receivables, paying that interest appears to be allowable, but not forgivable. So that could be a circumstance where it's okay to use the money, not okay for inventory, but it's okay to use the money for that item, but it will not enhance or increase the amount to be forgiven. So that, candidly, that created a whole nother thought process of, you know, if we don't have allowable expenditures that fully utilize all the money that was started with in the account, you know, the statute says that it'll be converted to a loan and paid out over the period of time, specified period of time with the interest rate. But we had an internal conversation. Could that mean that they want the money back right now because it's sitting in the account? We don't have an answer for that, but I expect that we'll get one here in the not too distant future.
Yeah, so really there's three baskets of costs. There's allowable costs, which is payroll, rent, utilities, interest on a mortgage, and interest on other debt incurred prior to February 15th of 20. And then there's forgivable costs that doesn't include that last one. And then in my mind, there's another bucket that's everything else. And you're not supposed to spend these proceeds on those items. And to the extent that you do, the question would be, do they want you to pay back immediately and you can't finance it over the 2-year period at 1%? We don't know the answer to that, but we think that that's a possibility, that they'll want the money back right away.
Okay, well, you know, one of the questions that we've also been hearing about with regards to, you know, forgivable or not, what about HSA contributions?
I think that's an allowable amount.
Yeah, it's employer paid HSA, right?
Okay. And then, you know, with regards to timing, what if we don't receive the funds till after May 6th?
Yeah, I think the 8-week period still holds, right, Fred?
Right, I think it does. They're going to have to change the June 30th deadline, I think.
Yeah.
Okay. And just with regards to kind of repayment and payroll again, if I don't think I can get the 75% payroll threshold for forgiveness, can I repay some of my loan now, essentially before May 7th, and just kind of lower the quote unquote denominator and, you know, better chances?
I don't think that's how the math works, does it, Fred? I think that it's the eligible expenditures as the denominator, isn't it? Or I don't know how repaying loan early would change that. Maybe I'm missing the question.
It would. You know, the odd thing is the banks that we talked to, you calculated your 2.5 months of average payroll, and that was your loan. You couldn't borrow some lower number. So I guess you could pay part of it back before May 7th. There's no prepayment penalty, but I don't know I don't know where that gets you. I don't know that it does you any good.
Right.
I don't think it reduces your forgivable amount.
Yeah, I think maybe the confusion there is that the fraction that we're dealing with really is established. Well, there's a headcount fraction, and then there's a percentage of your total eligible costs spent. And by repaying the loan, I don't think that changes that math.
Got it. Exactly. When it comes to, you know, the comparison and exactly what is being compared, is it the total headcount per the loan app versus the 630-20 headcount, or is it the headcount per the app compared to the average FTEs during the 8-week period?
You talking about for the fraction?
Sounds like that's what they're asking.
So the numerator of your fraction is your average FTEs for the 8-week period. And then the denominator is your choice between your average FTEs from February 15th of 19 through June the 30th of 19, or January 1st of 20 through February 29th of 20. Whichever number of the last two is the lower is obviously the one that you want to pick. The number of employees that you put on your application, if that number is for some reason different, than your denominator. It's because I think the question on the application is how many employees do you have now, not necessarily during one of the two testing periods.
So you're talking about on the for the denominator?
Right. Well, I think the question was you had to fill in how many employees you have on the application.
Right.
And it's the two testing periods that you pick between to do your fraction for your headcount reduction.
Yeah, the one thing that seems to be a practical challenge there that I'm not sure how to handle, we found a number of banks that, regardless that the statute said the April 1 of 19 through March 31 of 20, they really wanted calendar year of 2019 data so they could tie it directly to the payroll reports. So Fred, did you see that on occasion?
Absolutely. That happened more often than not. And that's what led me to believe that they're going to go on a cash basis during the 8-week covered period because they want to make it easy.
Right.
So we had banks actually make us go back and redo the computation for the calendar year 2019 so that it would tie to the 941s. We were trying to get ahead of the curve. The law said the trailing 12 months. We did our computations for the trailing 12 months. We submitted our application. And in at least one instance, they said, no, we want calendar year 2019. So they're trying to make it as easy to audit as possible.
So that begs the question, real quick, Dean, that begs the question then, would you use as your denominator the average head FTE for that calendar year period as the denominator?
No, it's got to be, it's the two testing periods. So it might be different. I guess the question was, my application says this, but my denominator that I'm calculating is a different number. Is that a problem? That's what I'm interpreting the question to be. Mm-hmm. And we actually ran into that yesterday, different number, but it's one of the two periods. And how you prove that is probably from your payroll records. Calculating your FTEs, and it can get really complicated if you have 225 employees or more.
Question about contractors. I completed my application before they disallowed contractors, so I've received more money than I can use because I can't count contractor pay. What's some guidance, or what are we seeing people do on this?
Ultimately, obviously, you're going to have to give the money back. Whether you do it by the May 7th date, is up to you. I think that would be a very conservative approach and maybe the safest, but ultimately, I would think that. I don't know, Fred, have you given that any thought?
I think if you pay it back at the end of the 8-week period, I think you're fine. So, I don't think the May 7th date and all the conversations and articles that we've had and stories on the news is geared towards those big Fortune 500 companies. They got $10 million PPP loans because they were in an industry that allowed, the headcount to be by location or some other reason, and they really didn't need the funds. They had some other way to work their way through the 8-week covered period without the funds. I don't think it's geared towards the independent contractor who's limited to $100,000 and then a $20,000 loan.
Yeah, Perry and Fred, I think the overarching theme of what we're hearing today is that we thought we had some clarity and we're not really. And now that we've got the dollars, it's going to be even more important that we're compliant, that we've gotten the dollars. And what's our plan going forward? Just give us some closing remarks on that and how we think we're going to be helping our clients doing that going forward.
Yeah, so I want to emphasize the fact that there's an important 3-step process with the funds, and we're available to help in any way, shape, or form, whether it be on the strategy side, help you set up the processes, get the documentation and package it up. We can do any and all of that. Whatever serves your needs best. I do think the guidepost in general about a lot of the questions where we don't have guidance is let's avoid doing unnatural things, okay? Unnatural acts that might appear to benefit or give the advantage. I do think under scrutiny, the mindset of these examinations or reviews of this information is, were the funds used for the intended purpose? Were the circumstances, of need? And again, I think that's a fairly low bar under all the circumstances that we've encountered in the last 6 weeks or so. And having your documentation readily available, complete, well organized, and make it easy for the person who has to make this recommendation or decision about your forgiveness. To the extent that there's errors or missing items and you've got to go back and forth, we just don't think that bodes well for the right outcome.
Yeah, I agree. And the only thing I would add to that is over provide, include your lease document, include your utilities agreement, you include, tie it up in a bow and have every single number that's coming out of your account documented with a computation with supporting information behind it, so that they spend 20 minutes on your loan instead of 2 days. So the more complete it looks and the more accurate it is, and that everything ties, the faster your loan's going to get approved and your forgiveness amount is going to be approved by the SBA auditor.
Yeah, the other thing I just want to throw out is to let you know, not only has our group obviously been focused on this from the beginning, we're now at a stage where we're having actual conversations with the lenders, the banks, because they, were slammed when they had to consider processing all these requests. I'm sure each and every one of you experienced the pain and agony of getting the information in, wondering what happened to it. Were you approved? Do they have questions? They were just drowning in being able to process this. Well, we've recognized this, and because we're so intimately familiar with all this, we're actually talking to banks so they may consider outsourcing to us the process of getting all the information in a format that complies with the law, and then giving it over to them at that stage and making it easy for them to go through, tick and tie, and approve. So we may be providing service on both sides. It looks like the banks are going to need help on this.
Think about this. I think the numbers were the SBA in an average year lent $50 billion. In a 10-day period, they lent $350 billion. And the banks were just inundated. I know I got emails and telephone calls on Friday and Saturday night from people that were checking our loan from Frost and every other bank, asking questions or asking for documentation. And so that's the reason that we felt like it was a good idea to offer our services. And I think in Dallas, and don't hold me to this, but we either consulted on or worked with probably $100 million in PPP loans that were funded.
Right.
So we're intimately familiar. That they weren't all where we did all the work, but we spent a lot of time with our clients going through this process. And so we're familiar with what they want to see and how they want to see it.
Yeah. Great. Well, I want to thank everybody for participating, their interest. Hope you found it useful. And, when you do get through this process, let us know if you need any help.
Thank you, everyone.
Thank you.